Okay, so like right now, everyone wants to know what's going to happen with housing, in 2025.
Yeah, it's a big question.
Huge question.
Yeah,
Whether you're, thinking about buying or selling or just kind of watching the whole economy.
right.
Like it really does feel like things are shifting.
Yeah.
So we're doing a deep dive today into how like federal policies are expected to shape all of that over the next year.
Yeah, we're going to try to give you a shortcut to figuring out all the, forces at play.
Absolutely. And for you, we're going to break down those federal policies into like two big buckets. First up is monetary policy, all the stuff the Federal Reserve is doing with interest rates.
Right.
And then we'll look at like other government actions, regulatory stuff, fiscal policies, the things that can really impact where the market goes.
Exactly. And our goal here is to take all the expert opinions, all the data, and just boil it down to what actually matters to you.
Yeah.
Cut through the noise so you can actually see what's going on.
Absolutely. All right. So let's unpack this beast, starting with the big one.
Okay.
The Federal Reserve, we hear about them constantly, but in plain English, what are they even trying to do?
So the Fed has this thing called a dual mandate.
Okay.
Basically, Congress has told them, keep employment high as you can sustainably, and keep prices stable.
Right.
So it's this balancing act, right? Trying to keep the whole economy humming along without letting inflation get out of control.
Yeah, so their like main tool for this balancing act is the federal funds rate.
Right.
What is that, and how does it eventually affect the actual mortgage rate that I might be looking at?
Okay, so the federal funds rate is basically the interest rate that banks charge each other to lend money, overnight.
Okay.
It's the cost of borrowing for banks from other banks.
Right.
Now, the connection to your mortgage isn't direct, but it's super influential.
Gotcha.
It mainly affects short-term rates first,
Okay.
but it ripples out to longer-term rates, like mortgages, in a couple of ways. First, it impacts the entire environment for interest rates, right, and yields on these short-term treasury bills.
Mm-hmm.
But maybe more importantly for mortgages, it affects the bond market, specifically the 10-year U.S. Treasury note yield.
Okay.
That's kind of a benchmark for borrowing costs over the long term.
Right.
Think of it like a, health indicator for the economy long term.
Okay.
Mortgage rates usually follow its lead.
Yeah.
And finally, it also impacts how much investors want mortgage-backed securities.
Okay.
These are bundles of mortgages that get sold off to investors.
Gotcha.
So if short-term rates are high, investors might look at those and be like, maybe not. They might prefer other less risky short-term investments.
Makes sense.
Which can then put upward pressure on mortgage rates.
So, okay, they've been, busy trying to fight inflation. What have they actually done with that rate?
Yeah. So the Fed, faced with this high inflation, they got pretty aggressive in 2022 and 2023. They were hiking that federal funds rate steadily. It peaked at a range of 5.25% to 5.50%.
Wow.
Between July 2023 and September 2024.
So that increase definitely had a ripple effect on the whole economy.
Yeah.
We saw it in the housing market for sure.
Yeah, it made borrowing way more expensive.
It did.
Yeah.
But as inflation started to show signs of easing, they kind of changed course, right?
Exactly. Between September and December of 2024, they actually cut rates a whole percentage point, bringing that federal funds rate down to a range of 4.25 to 4.50 by January 2025.
Okay. So where do things stand right now in mid-March 2025? Are they still cutting?
Right now, that federal funds rate is still sitting in that 4.25 to 4.50% range.
Okay.
And it seems like they're being cautious. Fed Chair Jerome Powell said in late January they're in no hurry to cut further. They're watching the data on inflation and the job market really closely to see what to do next.
Okay, so that's where we are now. The question is, for everyone listening, trying to plan what's going to happen with those interest rates the rest of this year.
Right. And that's the million-dollar question.
It is. We're seeing a lot of different predictions out there from the experts.
We are. And that really just shows you how uncertain the economic outlook is right now. For example, Morningstar, they're predicting that the federal funds rate will go down to 3.50% to 3.75% by the end of the year.
Okay.
They're thinking 3 more quarter-point cuts.
Wow. Okay.
Why? Well, they expect inflation to keep going down.
Okay.
And they also see slower economic growth and job creation.
That makes sense. So that would be a pretty significant drop. What's the market thinking in general? Like if we look at how people in finance are betting, what are they saying?
Yeah, so the CME FedWatch tool is a good way to see that. It looks at how these federal funds futures contracts are being traded.
Okay.
And right now, as of mid-March, it's showing a really high probability that the Fed is going to hold rates steady at their March meeting. In fact, the market thinks there won't be any rate cuts through May, with the first one maybe happening in June.
Gotcha.
By the end of 2025, the FedWatch tool says the most likely scenario is 2 quarter-point cuts, putting the rate in the 3.75% to 4% range.
Okay.
So the market is a little more conservative than Morningstar.
Interesting. What are some of the other experts saying?
Yeah, so Bill Adams, the chief economist at Comerica Bank, he's got an even more cautious outlook.
Okay.
He's predicting only a single quarter-point cut this year, probably around July.
Okay.
He thinks the Fed might want to see if there's a shift towards a more supportive fiscal policy later in the year.
Mm-hmm.
And if that happens, they might not be so quick to cut rates aggressively.
Interesting. Okay, what about the big players? Like, what's Goldman Sachs saying?
So Goldman Sachs, their economists, they're predicting 2 rate cuts in 2025 and then 1 more in 2026, which would bring that rate down to 3.5% to 3.75%. They've laid out a couple of ways this could happen.
Okay.
One is what they call normalization cuts.
Okay.
This is if tariffs end up lower than expected and inflation keeps going down.
Mm-hmm.
The other is insurance cuts.
Insurance cuts?
Yeah, they might do this to protect against potential economic risks, even if their assumptions about tariffs are right.
So it's not just about reacting to what's happening now, but also trying to anticipate different scenarios down the road.
Exactly.
Okay, what about principal asset management?
Seema Shah over there, she also sees 2 or maybe 3 rate cuts this year.
Okay.
And she really stresses that if we start to see the job market weaken with unemployment going up, the Fed might get more worried about keeping employment high, and then they could make bigger rate cuts.
Yeah, that makes sense. I mean, the job market has been a real bright spot lately.
Absolutely. It has. And then you've got Gregory Daco, the chief economist at EY. He's taking more of a wait-and-see approach.
Mm-hmm.
He's predicting 2 quarter-point cuts this year, probably June and December. He thinks the Fed wants to be super sure that inflation is really on a downward path before they cut more, so it doesn't risk inflation going back up.
Yeah, that makes sense. And finally, what about iShares? What are they thinking?
So the iShares team, they think the Fed will probably cut rates down to around 4% in the first half of this year.
Okay.
And then they'll probably pause to see what happens.
Okay.
How does the economy react, especially inflation and jobs, before making any more moves?
So we've got this whole range of opinions, but it sounds like the general idea is we're going to see some easing of monetary policy.
Right.
What are the big things driving all these different forecasts? What should people be paying attention to?
At the end of the day, it all comes down to a few key things in the economy. Inflation is the big one. Even though it's come down, it was 2.8% in February, it's still higher than the Fed's 2% target.
Right.
So if inflation is more stubborn than expected, the Fed might not be so eager to cut rates. The job market is another huge piece. Unemployment was 4.1% in February, which is still pretty low.
Yeah.
But if unemployment jumps up, that could mean the economy is weakening and the Fed might need to cut rates more aggressively.
To try to boost things?
Exactly. And then there's GDP growth. It's projected to slow down to about 2% in 2025.
Okay.
If that happens, the Fed might feel like they need to cut rates to try to juice the economy.
And then there are the wild cards too, right? Like trade policy and how consumers are feeling.
Oh, yeah. Those are huge. All the uncertainty around tariffs and trade can make prices go up and make the whole economy shaky.
Right.
Which makes it harder for the Fed to decide what to do. And remember that big drop in consumer confidence we saw in February.
Yeah.
Biggest in like 4 years.
Wow.
Could be a sign the economy is getting weaker, which could lead to more rate cuts, as the Fed tries to keep demand up.
It's a lot of moving pieces.
It really is, yeah.
So we have a sense of where interest rates might go.
Mm.
Now, the big question for anyone in the market or thinking about it is, how is this going to impact mortgage rates in 2025? It's not a direct translation, right?
Not at all. It's more complicated than that.
Right.
The federal funds rate kind of sets the overall direction, but mortgage rates are also influenced by a bunch of other stuff in the economy. And importantly, by what people think is going to happen in the future with the economy and what the Fed will do.
So given all these predictions for the federal funds rate, what are the experts saying about the 30-year fixed-rate mortgage, the one everyone's interested in?
Okay, so we're seeing a range of forecasts here, too. Fannie Mae, they're projecting an average rate of around 6.8% for the whole year.
Okay.
The Mortgage Bankers Association, the MBA, they're thinking a gradual decline, starting around 6.9% early in the year and going down to about 6.4% by the end.
Okay.
Whilst Fargo, on the other hand, they think rates are going to stay above 6.5% all year. The National Association of Realtors, they're saying an average of 6.5% for the first quarter.
Gotcha.
And the National Association of Home Builders, they're thinking an average of about 6.53% for the whole year.
Okay, so what about right now in the real world, early 2025? Where are rates at?
So right now, for a 30-year fixed rate, mortgage rates are mostly between 6.6% and 7% as of like mid-March. Freddie Mac said the average was 6.65%.
Okay.
And the thing is, current rates are already pretty close to some of those yearly averages.
Mm-hmm.
So we might not see huge increases from here.
So it seems like those really low rates we saw before 2022 are probably gone for now.
Yeah, that's what most people think.
Okay.
A lot of experts believe that 6 to 7% is probably the new normal for a while.
Okay, so besides the Fed's decisions, what else affects mortgage rates?
So a few big things come into play. Expectations about future inflation are huge. If lenders think inflation's going to go up, they'll want a higher interest rate on long-term loans like mortgages.
To protect themselves.
Exactly, to make sure they're still making money.
Makes sense.
And then that 10-year U.S. Treasury note yield we talked about, that's really closely tied to 30-year fixed-rate mortgages.
Right.
Even though that yield is expected to come down a bit, it's still probably going to stay higher than it was before the pandemic.
Okay.
Which could put a limit on how much mortgage rates can fall, and then there's how much investors want mortgage-backed securities.
Right.
If investors aren't that interested in those, lenders might need to offer higher mortgage rates to make them more appealing.
Gotcha.
And of course, when the economy is uncertain, lenders get nervous and they charge higher rates to cover the risk that people might not pay back their loans.
Yeah, that makes sense. And then you also have the potential for government policy changes.
Right. Oh.
Like if they start talking about tariffs again.
Right. That could make prices go up, which would make it harder to bring mortgage rates down.
Okay, so these higher rates are definitely going to make housing less affordable for a lot of people. What's the picture looking like as we go through Clown 25?
Yeah, the truth is, with rates staying high, monthly payments for homebuyers are going to stay high too.
Right.
Which makes it tough to afford a house.
Right.
The median monthly payment in January was already close to its all-time high.
Okay.
Now, if rates do go down a bit, like some people are predicting, that could help a little.
Mm-hmm.
And it might bring some buyers back into the market who are waiting on the sidelines.
Right.
But the combo of still high home prices in a lot of places and these higher rates means that overall affordability is probably going to be a struggle for a lot of people throughout the year.
Yeah.
We might see some buyers looking into adjustable rate mortgages, ARMs, as a way to get a lower payment at the beginning, but that comes with its own risks.
Right. So what about how many homes are being sold? Are we expecting more or fewer transactions for people who want to buy or sell?
So because of the affordability challenges, we're probably going to see a slowdown in the number of homes being sold compared to the past few years when rates were much lower.
Okay.
We actually saw a almost 5% drop in existing home sales in January 2025 compared to December 2024.
Right.
But if rates do come down more than expected, that could definitely boost sales.
Yeah.
Interestingly, Bright MLS, they're actually forecasting a pretty big year-over-year increase in existing home sales, so there's still some optimism out there.
So mixed signals on sales. What about home prices? Have they started to come down?
Yeah, so with demand cooling off because of higher rates, we could see a slowdown in how fast home prices are going up.
Okay.
And we might even see prices drop in some markets where they've really shot up.
Mm.
But one thing that's still a problem in a lot of areas is low inventory.
Right. Not enough houses for sale.
Exactly. And that tends to keep prices from falling too much.
Okay.
Most sources like BrightMLSRealtor.com, Redfin, they're thinking prices will probably keep rising, but at a slower pace, maybe 3 to 4% per year in 2025.
Okay, so what about real estate investors? How is all of this going to affect them?
Yeah, so higher interest rates can definitely squeeze profits for investors who use loans to buy rental properties.
Right.
So they might be looking more carefully at properties that will make money right away,
Mm-hmm.
or finding different ways to finance deals on the commercial real estate side. Slightly lower overall rates have actually made it cheaper to borrow money,
Okay.
which might encourage developers to start new projects.
Yeah.
And if mortgage rates do drop even a little, that could actually increase demand for rentals.
Right, because some people might put off buying a house.
Exactly, and that could push rental prices up.
Okay, so it's clear these policies aren't going to affect everyone the same way.
Right.
Like it matters where you are, what kind of property you want, your individual situation.
Absolutely. Geographically, those Sunbelt states like Texas, Florida, Arizona, they're expected to see a lot of activity.
Okay.
Partly because there's so much construction going on and more options for first-time buyers.
Mm-hmm.
But within those states, some places that have had a huge influx of new homes, let's see prices level off a bit.
Right.
And then the Northeast, which always seems to have a housing shortage, could continue to see issues with affordability and just not enough homes for sale.
Yeah.
And those high-income cities like New York, Boston, D.C., they might actually see prices go up faster.
Okay.
Because there's so much demand and not enough supply.
Okay, what about different price points in the market?
So that middle tier, homes in the middle price range, that's probably going to be hit hardest by affordability issues.
Right.
Because those buyers are really sensitive to changes in rates.
Makes sense.
Higher end homes, and, over $500,000, they've been doing okay.
Okay.
And then for entry-level homes, it's going to stay tough for first-time buyers.
Right.
Prices are high, rates are high. It's a tough combo, but we are seeing some builders trying to focus on smaller, more affordable entry-level homes in some places to try to meet that demand.
Yeah. So how are different generations expected to handle all this?
Yeah, so millennials and Gen Z, they're prime home buying age now.
Right.
So there's a lot of demand from them for affordable homes.
Mm-hmm.
But they're also the ones who are most likely to have trouble affording a place.
Yeah.
So a lot of them might have to put off buying and keep renting for longer.
Yeah.
And then you've got baby boomers. A lot of them are staying in their homes as they get older,
Right.
which is part of why there aren't that many homes for sale.
Right.
But as more of them get into their 80s, we might start to see more houses come on the market as they downsize.
Interesting. Okay, so we've looked at the current predictions, but what if things don't go as planned? What are some other scenarios that could happen?
Okay, so there are a few key alternatives that would really shake things up. One is what they call a soft landing,
Okay.
which is what the Fed is hoping for: moderate inflation, gradual easing of rates.
Okay.
If that happens, we could see things get a little better with affordability and maybe a small increase in home sales. Some analysts are thinking we'll see steady but not spectacular economic growth, around 2% in that scenario.
Okay, so that's kind of the best case. What if inflation doesn't cooperate?
Yeah, if we get stuck with persistent inflation, the Fed might have to hold off on cutting rates or only cut them a little,
Right.
which means mortgage rates would probably stay high,
Yeah.
making affordability even worse and maybe even cooling down the market further.
Okay, so not great. What about if the whole economy takes a hit?
Right. So in an economic downturn or a recession, you'd probably see job losses and people getting nervous about spending money,
Yeah.
which would definitely hurt demand for housing. But in that situation, the Fed would probably slash rates to try to get things moving again,
Right.
which would bring mortgage rates down. It's important to remember that unlike back in 2008, most homeowners now have a lot of equity in their homes.
Right.
And a lot of them have fixed rate mortgages at pretty low rates. So that could help keep things more stable.
Okay. And then there's the possibility of big changes in government spending, right?
Right, a big fiscal policy shift. Like if a new administration comes in and makes big tax cuts,
Okay.
that could pump money into the economy and maybe increase demand for everything, including housing.
Yeah.
But it could also make inflation worse and push rates up.
Right.
On the other hand, if they cut regulations on construction, that could actually increase the supply of new housing over time.
Interesting. So it's not all doom and gloom. Okay. So it's not just about interest rates and the economy, though.
Right.
Right. There are also specific federal policies that people should be aware of.
Yeah, exactly. There are changes happening that could directly affect the housing market.
Like what?
Well, keep an eye on Fannie Mae and Freddie Mac.
Okay.
People think the Trump administration might try to change things up with them.
Go.
Maybe try to get them back on their feet financially and potentially even release them from government control.
Okay.
And we're also seeing new rules coming from the Federal Housing Finance Agency, FHFA, like those new tenant protection standards for apartment buildings that are backed by Fannie and Freddie.
Right.
Those just went into effect at the end of February.
Yeah, those are aimed at giving renters more rights and security.
Right, exactly. And then there are the government's efforts to address affordability.
Right, which is a huge concern for a lot of people. What are they doing there?
Yeah, so the Biden administration has proposed some things to try to make housing more affordable.
Like what?
Well, one idea is to limit how much landlords can raise rents.
Okay.
They're talking about penalizing landlords who hike rents by more than 5% per year.
Okay.
But it's still got to get through Congress.
Right.
And there's also new federal money going towards building more affordable housing through programs like PRO housing grants and transit-oriented affordable housing. Those are all about lowering costs and giving people more options.
And could changes in the tax code also affect the housing market?
Absolutely. If a new administration comes in and cuts taxes or changes deductions, that could have a big impact on both demand for housing and how affordable it is. For example, changing the capital gains tax rate could change how investors see the housing market and how they behave.
Interesting. Okay, so let's shift gears for a minute and talk about renters. How is all this going to affect them in 2025?
So the rental market is expected to stay strong. There's still a lot of demand, partly because buying a house is so expensive, and partly because of demographic trends, people moving around, getting older. We'll probably see rents keep going up in a lot of places. But how much they go up will depend on where you are and how much supply and demand there is. Like some of those Sunbelt markets where they've been building a lot of new apartments might see slower rent growth because there's more supply.
Makes sense.
One thing that's worrying is there might not be enough money for federal rental assistance programs.
Like what?
Like the Housing Choice Voucher Program. If they cut funding, that could hurt a lot of low-income families who rely on that help. And then the overall shortage of affordable rentals for lower-income people, that's still a huge problem everywhere.
It is. Okay, so technology is changing everything. How is it affecting the housing market?
Oh, technology is having a huge impact, and it's not stopping. We're seeing those online real estate platforms getting better and better. And it's easier than ever to apply for a mortgage online, which changes how people buy, sell, and rent properties. And then you've got artificial intelligence and all this data analysis. It's being used to give people personalized recommendations for properties and really detailed insights into what's happening in the market.
That's wild.
And then virtual and augmented reality. It's giving people a way more immersive experience. You can tour houses remotely, even see what renovations might look like. And then there's this thing called a digital twin.
A digital twin?
Yeah, it's like a virtual copy of a real building. And that's becoming more common in development and management.
That's so cool.
And of course, all the remote work that's happening is changing where people want to live. Which can really affect demand in different areas.
So looking beyond this year, what are some of the big long-term challenges facing the housing market?
Yeah, so there are a few really important ones. Climate change is a big one. We're seeing more natural disasters happening more often, and they're getting stronger. Which is a risk for property values and could make insurance for homeowners more expensive. So federal policies that deal with those risks and encourage building houses that can handle climate change are going to be really important.
Makes sense.
And then there are demographic shifts. The population's getting older, which means we need more housing options that are accessible and affordable for older people. And then there's the ongoing demand from younger generations that's going to shape the market for decades.
Absolutely.
And we also need to fix some basic stuff in a lot of places, like infrastructure and zoning laws, to make housing more accessible and affordable in the long run.
Okay, and obviously the U.S. housing market isn't in a bubble. It's connected to the whole world, right?
Oh, yeah, absolutely. Global stuff can have a huge impact on the U.S. market.
Like what?
Well, different interest rates in different countries and changes in currency exchange rates can affect how much foreigners invest in U.S. real estate. And problems with global supply chains can make building materials more expensive and harder to get, which could affect how much new homes cost and how long it takes to build them.
And then major events in the world can create uncertainty in the economy, which can indirectly affect interest rates here and how confident investors feel about the housing market.
Exactly.
Okay, so we've covered a ton today. What are the most important predictions and takeaways from all the experts you've looked at?
Okay, so the big picture seems to be we're looking at a slowdown in the housing market this year. Prices will probably still go up, but not as fast as they have been. Mortgage rates are expected to stay high, probably above 6%. Which is going to make it hard for a lot of people to afford a house. We'll probably see more houses come up for sale, which is good news for buyers. The Sun Belt is expected to do better than other parts of the country. And that lock-in effect, where people don't want to sell because they have such low mortgage rates, that's probably going to keep the supply of houses for sale lower. Oh, and Realtor.com, they're actually predicting a little bit of a rebound in home sales this year.
Okay, so it sounds like a market that's still trying to figure itself out after all the craziness of the past few years.
Yeah, exactly. It's juggling all these different economic forces and trying to adjust to changes in federal policy.
So given how complicated all this is, what are some big areas where the government could make good policy decisions that would actually help people in the housing market?
Okay, so generally speaking, policies that focus on a few key things could make a real difference.
Okay, like what?
Increasing the overall supply of housing at different price points so there are more options.
Yeah.
Making sure those federal rental assistance programs have enough money to help people who need it most.
Right.
Encouraging energy efficiency and climate resilience in housing so it's better for the environment and saves people money. Figuring out how to meet the needs of the growing population of older people.
Right.
And keeping a close eye on what's happening in the global economy and taking steps to protect the U.S. housing market from any negative impacts.
This has been a serious deep dive into the 2025 housing market, and the role the government is going to play. It's obviously a really complicated situation.
It is, and as we've said, all these forecasts are helpful, but the truth is, what actually happens will depend on how all these different factors interact and change throughout the year.
Absolutely.
Yeah.
So for you, our listener, as you think about everything we've talked about today, what's the one thing about the 2025 housing market that you think will have the biggest impact on you or the economy as a whole? It's definitely something to think about. Maybe do some more research on your own. Thanks for joining us for this deep dive.
Thanks for having me.
And we'll see you next time.
See ya.
Bye.